Do you know how much how much capital I've invested in Bitcoin at this point, Raoul? I think that Bitcoin is the most decentralized digital property, right? It's the highest quality digital property. We want to create a digital property running on a decentralized network that's owned by everyone and no one, right? That's the real key. It can't pass the Howey test. We can't have, no one can shut it down. You can't have people upgrading it every quarter or every 6 months. You can't have a CEO of it. You can't have a CTO of it. You can't, you need to have something completely decentralized. Once you've got that, now the velocity of the digital property, and again, when you call it digital energy, you start to see it differently. You realize you can accelerate it on layer 2 platforms. And there are a lot of decentralized layer 2 platforms. So Lightning is a decentralized layer 2 platform. You could say that many of the other cryptos, to the extent that they're decentralized, they're layer 2 platforms, right? There's going to be a battle to see which cryptos are truly property versus which ones are security. And Gensler has said that on no less than 4 different occasions. He thinks many of these cryptos are security. So as we start to see more guidance there, he's also said some tokens are commodities. So as we sort out which token is commodity and which token is a security, you're going to have a competition of layer 2 tokens. The Lightning Network runs on a layer 2 on a token which is Bitcoin, right? Which is an interesting thing, but I think that you're going to see a competition there, and then you're going to see layer 3s. And layer 3s I define as CeFi, centralized finance applications like Square or PayPal or Coinbase or Binance, right? All of those are moving large sums of Bitcoin at high velocity. Square's got 30 or 40 million customers, and you can move any amount of Bitcoin from Square Cash Tag to Square Cash Tag instantly for free. So as you start to see those, they're going to create an accelerated finance. Between you and me, I'm not sure that decentralized finance needs a decentralized layer 2. It needs a decentralized layer 1. Like, you need digital energy to exist in order to move it at the speed of light 100,000 times an hour across 100 jurisdictions in order to do yield farming. So you need digital energy, and Bitcoin is. You need one. Do you need 2? Not necessarily. You need one digital token that you can move at the speed of light 1 million times a second. If I've got that, JP Morgan can get in this space. Coinbase can get in this space. Square can get in this space. Square's a bank. There's this Coinbase wants to have a lend product that has yield. The SEC says that's a security. They can't offer it. Okay, well, they didn't say you can't offer it. They said you actually have to register it under the SEC 40 Act. There are plenty of organizations that offer money market funds with yield. You're either a bank and you offer a savings account with yield and you subject yourself to banking regulation, or you're issuing a security and then you have to file that with the SEC. You're running a fund, and the NYDIGs of the world and the Fidelities of the world, they're filing their funds, with the SEC, and they're getting SEC authorization for that. If the only trade you do is you buy $1 billion of Bitcoin with debt or equity or whatever and sit there and wait, it's a pretty good trade. And it's you don't need to take all these other risks. It's like people ask me, are you lending out your Bitcoin? Are you trying to get yield? I'm like, well, we're getting 130% yield on average for a decade, but we got 250% or whatever. Why would I risk losing it all for 5% more?
I mean, I'm the same. I don't do any of that because it's a risk that I can't quantify and it's unnecessary.
Buy a high quality property and wait. And I would say take all that energy. All these companies jumping through hoops, juggling razor blades to figure out how to do something complicated. Something simple is just take your $1 billion of cash and credit and convert it to Bitcoin. All the balance sheets of the world, all the balance sheets of every company, they're sitting on cash and credit that's crumbling, right? It's not even debated. Everybody knows the debt is losing purchasing power. Everybody knows the cash is losing purchasing power. And every one of these companies has the ability to borrow money or raise capital, at obscene rates, right? You're raising capital at revenue multiples that are obscene, and you're borrowing money at interest rates that are lifetime low. So there's plenty of capital. There's one obvious trade. Just convert crumbling cash and crumbling credit into digital energy, into pure property, which is not debasing or degrading. It's that simple. It's a simple idea. It's almost too simple. So everybody has to look for the second derivative, the third derivative, some complicated idea. And I guess where I come back on is like, I'd rather spend 1,000 hours figuring out how to borrow the next $1 billion and buy Bitcoin than spend 1,000 hours creating a software company to do something complicated with Bitcoin. I mean, I think in every month for the past 13 months, there have been positive developments that give us more confidence in Bitcoin. The result of the election was a positive development. The regulatory regime, I think, is a positive development. I think we had 0 public companies holding Bitcoin before MicroStrategy, and now there's like 25 maybe. By the end of this year, we'll have about a dozen Bitcoin miners that have come public. And if you look at the success of the miners like Marathon and Riot, and I think I just read a few days ago that Hut 8 is doing a secondary offering. You've got SPACs in the work from TerraWolf. You've got Core Scientific coming public. You've had Coinbase come public, right? Since we last spoke, you've seen Coinbase not just come public in a $1 billion IPO. Coinbase also brought a $1 billion convertible offering to the market. And then just a couple of days ago, they brought a $1.5 billion junk bond offering to the market, and they upsized it to $2 billion. And they raised that money at 3.5%, a blended rate of 3.5% interest. So, what I've said from the beginning is it's important that we carve a channel between the ocean of traditional assets and the crypto pond. If you'd ask who's driving the industry a year ago, you would have said retail investors with 10, 20, 30, 125x leverage on an offshore exchange. And if you'd ask the question, who's driving the industry today? Well, it's a hodgepodge of a lot of different players. I mean, you've still got, the offshore exchanges, but now they've allowed that they will back down to 20x leverage, to be more conservative. So there's no doubt that offshore crypto leverage money is in the system. I think it drives volatility,
sure,
in my opinion, more than it drives sustainability. If you want to see Bitcoin go to $10 million a coin, then it won't come from 125x or 20x offshore levered contracts and traders. It will come from insurance companies and macro hedge funds that have capital, $100 billion of capital, and they just allocate 5% of it to Bitcoin forever. And when you start getting 5% allocations forever, then you'll start to build a monetary base and a capital base that will drive the industry. If you're going to be in the Bitcoin mining business, then you're naturally long Bitcoin. And if you're naturally long Bitcoin, it's inconsistent to ever sell it. So if you're a Bitcoin miner and Bitcoin goes to zero, your business is worth zero. And if Bitcoin goes up and you sold your Bitcoin, your business is worth 20% of what it would have been worth. So if you really are a Bitcoin miner, you're long Bitcoin, which means you hodl all the Bitcoin. And so at this point, I think you see an emerging consensus in the past 12 months that if you're a Bitcoin miner, you should never sell it. Okay, now that's only consistent with the idea of Bitcoin miners all coming public in the North American markets. If you're a Chinese Bitcoin miner, you didn't have the capital markets to not sell it. You have to dump it on the market, right?
Yeah.
And the narrative was always, oh, the miners are dumping, they have to sell their Bitcoin, right? Watch the miners. And if you're a Bitcoin miner, Raoul, in Europe, or if you were trading on the Canadian Stock Exchange or the European Stock Exchange, if you dig a little bit deeper, you'll find that those companies had a liquidity of like $2 million a day, $1 million of trading a day, $5 million a day on a good day. If you look at the liquidity in Marathon and Riot, 400 million a day, 250 million a day.
Incredible.
Okay, so wake up call. You move from a cash business to a small to the secondary public markets, to the primary public markets. When you move to the primary public markets, let's take MicroStrategy. MicroStrategy had a full market capitalization of $1 billion before we, in August of last year, with 500 million in cash. And we've had days where we traded $1 billion worth of equity. Now we have 500 million in liquidity a day. Okay, so what is that telling you? Right, the answer is as the companies in the space come public and as they migrate to the capital markets with the greatest amount of capital, if you can raise equity capital, at a high multiple, that's cheap capital. If you can raise convertible debt, since we talked, MicroStrategy did a $650 million debt offering and paid 75 basis points, but then we followed up with a $1.05 billion debt offering and paid zero interest. And then we followed up with a senior debt offering and we paid 6 1/8 interest on just junk debt. There's nobody in the space that thinks that Bitcoin isn't going up 6% a year.
No.
Nobody. So the issue is, do you know how much how much capital I've invested in Bitcoin at this point, Raoul?
No.
$3,335 million.
That's pretty spectacular.
So one person.
Yeah.
But I didn't have $3,335 million in my piggy bank when we last spoke.
Yeah.
Now, what happens if more than one person does this, Raoul?